Jeffrey Currie, can we see oil fall below $30 a barrel?
You know, absolutely. When you look at what Saudi said yesterday, that when they slashed the price of oil over this weekend, that the likelihood that the demand for that crude is upwards to around 12.3 million barrels per day. That's an extra 2.5 million barrels per day during the month of April. That doesn't even include the increase that the UAE has talked about.
Right.
There's going to be a lot of competition from the refiners for those spot barrels that were already on the market. If you end up backing up oil into the mid-continent of the U.S., you could see, markets like WTI, Midland, really disconnect to the downside. So we're far from being out of the woods here. We think there's a lot more substantial downside risk.
Give us an example, just one vignette of the elasticities around the price equilibrium of oil given these multiple shocks. Give us just one vignette, for example, of how Russia defends itself against the Saudi reaction as they both try to move hydrocarbons to Europe.
Well, when we think about, the magnitude of the increases, what it's going to do is it's really going to stress the system in terms of delivery, storage. You're already pricing pricing floating storage outside of the U.S., but you have not got to the point that the U.S. has the potential to actually blow out the front end. And so, I would tend to think that as you start to see this physical crude move onto the markets as we get closer to the month of April, that's where you're going to start to create real dislocations, and that's when you'd expect to see, markets like Brent really start to potentially trade below $30 a barrel.
Jeffrey, I can't really understand why there's a price war between Russia and Saudi Arabia. Saudi Arabia saying that they would put something like 12.4 million barrels from April. The UAE with ADNOC today saying they will add 4 million right at this time. I mean, the timing couldn't be worse.
Well, actually, I like to say that this price war, and I like to say it a market share strategy as opposed to a price war, really is a second-round effect of the virus, meaning that the virus had already crippled demand, prices were already off, and here's the key. The economic justification for those cuts never made sense to begin with. Remember, our core thesis going back to 2014 was this idea of the new oil order, meaning that these low-cost producers like Saudi and Russia no longer have market power because of shale. Right. In fact, you look at the damage that these cuts did. They cut 4.4 million barrels per day, OPEC Plus did over that time period. You know what it generated? 5.7 million barrels per day of new supply. And more importantly, the supply cost equity shareholders dearly. We actually estimate it cost them $1 trillion. So this thing has a huge deadweight loss, never made economic sense to begin with.
Okay, but so Jeffrey, does it mean that actually, oil has to be at $20 to get rid of those shale producers, and then do they not come back online, when it goes back to 35
actually,
or 40?
If you were Saudi Arabia and Russia, what you'd want to do is create zombie companies out of these shale producers, ones that are laden with debt and can't invest and cannot grow. If they go to bankruptcy, which I don't think they could thread the needle to that, the assets, unless you go blow them up or something like that, they're still there. They'll change hands to a better balance sheet, a new management, more efficient operation. It means the cost structure is likely to go down. Plus, what about all that debt tied to those high-yield producers? You got to do something with all of that. That, again, is likely to be, moved to, taken down, written down, and you end up with a much lower cost structure.
You mentioned deadweight loss. Professor Currie, let us talk about the distinction here. The media and a lot of research as well is price, 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 price. And you correctly go to the unit dynamics of a tangible asset. Because it's a thing, it's on a boat off Singapore or whatever, how do the unit dynamics of a tangible asset fold into this ability to sustain at these prices or sustain at $28 a barrel?
And I think that point is really critical to what separates commodities in the physical world from the financial world.
Exactly.
The financial world has very little frictions. They think that you can solve a problem immediately, and I think the supply chain issues are going to become apparent. If a ship's in the wrong part of the world, getting it into the right part of the world can take 3 to 4 weeks. It's not instantaneous. And I think going back to your question of what adjusts at the margin in the oil market, as these excess barrels come into the market and try to find a home, you have to find physical storage for them. And if you blow out physical storage, that's when you get the big dislocations. to the downside.
I think Exxon's back to 2005 price. John Golub with Credit Suisse. You're listening to Jeff Currie here at Goldman Sachs give a clinic on the microeconomics of oil. Give me a clinic on big oil right now. Can Credit Suisse, with all your heritage of Mark Flannery and all the great securities research heritage of your shop, can you get behind big oil with these diminished prices?
Well, first, if you're looking at the market, I mean, I think oil is less than 3% of the S&P right now in terms of market cap, which is quite amazing. The bigger oil companies are not showing as much stress, but if you look at the high yield spreads in the energy space, it tells you there's a lot of pressure. Yeah. What I'm wondering is, at what point in time does the administration get involved here?
Interesting.
If both Russia and Saudi Arabia are players in this, at what point does the United States start to push back on this?
John, you're asking a question of Jeff. When does the U.S. step in here with these price declines?
Well, obviously, I would say the right answer is let the market do its stuff, because you will end up with consolidation, much stronger companies, much healthier companies. But given the severity of that, I like to point out, just in the 2 days since this began, the carnage that you see in the U.S. oil patch is significant, likely engendering a response. I don't want to speculate what could potentially come out of that, but our view would be much more let the market take care of it, because you would get a much more efficient industry out of it that can compete with the likes of the Russian oil companies as well as with Saudi Aramco.